Hey everybody, look, Quasar Marcus Law. Look what we got. Dr. Alan Ellman. I love this, Alan. How are you today, man?
Doing great. Just back from the gym and ready to go, Steve.
Well, I love this one. This one has got Bitcoin written all over it and options. So I think you just hit the nail on the head with everybody. So I'm going to leave you alone. I'm going to let you get right to it. And here we go.
Okay, Steve, this morning I'm going to talk about another way to protect your portfolio in bear, volatile, and uncertain markets, and that's with a trade known as the collar trade. Now, I'm using a Bitcoin exchange traded fund, IBIT, to bring home this example of how the strategy works. So, we're going to be using the BCI collar calculator, a spreadsheet that I developed. And I'm also going to show you our trade management calculator, another spreadsheet that I developed, how you can calculate these collar trades. So once again, the underlying security is iShares Bitcoin Trust listed on the NASDAQ under the ticker IBIT. And we're going to talk about buying shares or perhaps already owning them, writing a covered call, agreeing to sell those shares at a price that we determine by a date that we determine, and then, in addition to that covered call trade, buying a protective put, like insurance almost, to protect against catastrophic loss to the downside. So let's get started, Steve, with the next slide. And here's an overview of how we're going to do this. The most well-known form of crypto is Bitcoin. I think we can all agree with that. And I'm frequently asked by members of the Blue Collar Investor, how can I incorporate crypto into my covered call and cash secured put trades? Well, IBIT or Bitcoin ETF is a great way to do it because it has a very robust implied volatility. Not a crazy high implied volatility, not an ultra risky volatility, but a robust one. And that's perfect for selling options. And so IBIT is a good underlying, if you believe in crypto, to use with covered calls and cash secured puts. Now, in this particular discussion, Steve, we're going to be using a 29-day collar trade, and we're going to analyze it using IBIT to construct what initially is a defensive, modest return trade. Because when we compare it to just the covered call aspect, as you will see, the returns are lower, but still significant. But the returns without the protective put would be extremely impressive. So with that said, let's go on to the next slide. So let's first define IBIT. This is an exchange traded fund, an ETF, and the shares are constitute a way that we can participate in Bitcoin with actually buying Bitcoin, but by acquiring and holding the ETF itself. Now, once we own 100 shares of IBIT, we can then write a covered call because for every options contract we sell, in order to be covered, we must first own 100 shares of that underlying security. Once again, IBIT has a robust implied volatility, and that will allow us to set up our trades in a defensive posture, in other words, the collar, and still generate significant annualized returns. And I'm going to show you that using two different spreadsheets. Next slide. So what is the collar? Well, most people are familiar with a covered call. You buy a stock or perhaps already own it in 100 share increments and then sell options, one options contract per 100 shares, agreeing to sell your shares at the strike price by the expiration date. And we, the option sellers, set the parameters of that contract. Now, so you could see on the graphic, the covered call option sets a ceiling on the trade. So if we buy a stock at 48 and sell the $50 covered call, if the price of the stock goes beyond 50, we don't participate in that appreciation, but we do participate between 48 and 50. Now that's the covered call aspect. Now the protective put, it sets the floor. You see the red arrow on the left side. That sets the floor. So if we bought a stock at 48 and sold the $50 covered call, but then in addition to that, purchased the protective put at 45, and let's say that cost us $1. So we had a credit of $2 on the call side and a debit of $1 on the put side. We have a net credit of $1. And that represents greater than a 2%. And if it's a monthly, 2% 1 month return. So you could see that it's still a significant annualized return. And we have protection against catastrophic loss below 45 because that sets the floor. In that particular hypothetical, if the stock was 48 and goes to 20, now I'm exaggerating, but let's say that happens, we have the right to sell it at 45. So that's the collar trade. And by the way, just as a fun fact here, Steve, this is the strategy that Bernie Madoff pretended to use back in the day. He called it the split strike conversion strategy, but in essence, it was simply the collar. And that's what makes this whole Madoff thing so ironic, is that he actually could have made money for his clients had he, A, known what he was doing, and B, actually executed the trades. So the collar is a very important strategy for those that want substantial protection to the downside. All right, let's go to the next slide and start getting into some real life action here. So on January 23rd, about 10 days ago, IBIT was purchased at $50.55, 500 shares. That means we could sell 5 contracts. Remember, 1 contract equals 100 shares. So what happened? I sold 5 of the 220, a little less than a month. You'll see it's 29 days, a little less than a month of the 52 out of the money calls. That set the ceiling and generated $165 per contract. And remember, there were 5 contracts. Now, at the same time, I bought 5 of the 220, same expiration date, 48 puts. That means I can sell my shares at 48. So if IBIT drops way down, I still have the right to sell those shares at 48. That cost me $1.08 per share, $108 per contract. And again, it was for 5 contracts. So if you take a look at the credit of $1.65 per share and a debit of $1.08 per share, you could do the quick math and say, okay, we have a net credit of 57 cents per share. Next slide, please, Steve. All right, so now you're looking at the options chain on January 23rd. Let me give you an orientation here. On the left side is the calls. So an option chain is just a price list of options. So you see on the left side are the call options, and on the right side are the put options. Now in the yellow, we'll start with the calls. You could see that the 52, that oval, yellow oval towards the bottom, that's the strike price, had a bid price of $1.65. So we always sell at the bid, we buy at the ask. And the difference is called the bid-ask spread. And that difference is pocketed by the market makers. All right, so that's your credit, $1.65. Now let's look on the right side, Steve. And all the way at the top in brown, it's the brown cell, you could see that the 48 put, again, allowing us to sell the shares at 48, had an ask price, because we're buying it now, of $1.08. So we have a debit of $1.08, a credit of $1.65, net credit 57 cents. So that's a screenshot of the option chain on the day that these trades were executed. Next slide. Okay, now first I want to show Quasar viewers the calculations of just the covered call. Then we'll add in the protective put using both spreadsheets. This, folks, is our trade management calculator, or TMC. I've shown this probably at just about every presentation I've done at these Quasar events. And the very top of the screenshot shows the trade entries. So on January 23rd, we have the 220 expiration. The price of the shares were $50.55. The 52 out of the money call generated $1.65, 500 shares. Now, the spreadsheet will do the following calculations. Circled in red tells us it's a 29-day trade. counting the day that the trade was entered. The yellow cell shows the break-even price point. That's just the price of the stock minus the entire premium. Now, let's get to the meat and potatoes, Steve. In the brown cells, we have the initial 29-day returns. Covered call only, remember. This is prior to the put. 3.26%, that annualizes out to 41.08%. Very, very significant. These are the type of trades that I've been making now for the last 30 years. You would use these in normal to bull market environments. In a very uncertain or bearish or volatile market, I might opt for in the money calls, and that's something we can address at future discussions. In addition to that, we have an additional upside potential possibility of 2.87%. In other words, if IBIT goes from 50.55 up to or beyond the 52 strike, we could generate an additional 2.87%. So if we add that to the 3.26%, we're setting ourselves up, covered call only, for possibly a 6% 29-day return. Now oh, and by the way, one last thing. In the pink cell, that shows you the amount of cash generated for the covered call aspect, $825. That's $1.65 times 500 shares. So that's the initial covered call trade. Now let's go on to the next slide and focus in on the collar using the BCI collar calculator. And here we're adding in the protective put. So in the white cells at the top, we just enter 50.55, the 52 out of the money call for $1.65, the 48 out of the money protective put for $1.08. Just put those into the white cells, and here's what that spreadsheet will tell us. Now, you'll see here, it looks like a 28-day trade. It's really 29 when you count the day that the trade was entered. With our trade management calculator, we actually overrid the Excel spreadsheet formula to include the day that the trade was executed. It's actually a 29-day trade. 28 would exaggerate the annualized returns. All right, so the net credit is 57 cents. I alluded to that earlier. The red arrow shows that the return, the initial return on the collar now, factoring in the cost of the protective put, is 1.13%. That annualizes out to 14.7%. That's still significant, even with the purchase of that insurance, putting a floor on the covered call trade. Still an annualized return close to 15%. Now, the green arrow shows that if the share does move above the call strike, higher than 52, that our return will be 4%, right, for the 29 days. So that would be the max return of the collar, 4%. Remember, with the covered call, it was 6%. Now, when we were to annualize that, that would annualize out to over 52%. Now, the purple arrow shows that what if the price drops below the floor, below the protective put strike of 48? Well, here we have a loss of 3.92%. That's the max loss, and that would annualize out to a little bit higher than 51%. So we've structured our trade that will give us a maximum profit, that's our ceiling on the call side, and a maximum loss on the put side. And yet we're selecting, generally speaking, elite performers that we expect to at least stay the same and hopefully go higher. And so that's how we're crafting our trades. This is what Bernie didn't do. All right, let me show you now one more thing before we go, Steve. I want to show you how you can actually use collars with our trade management calculator. We can move on to the next slide. Now, all you have to do with the trade management calculator is, instead of entering a call premium of $1.65, enter the net premium of 57 cents. And there you'll end up with statistics that you should be familiar with from the last slide. Our net return is 1.13%, annualizing out to over 14%. And the upside remains at 2.87%. So we can get a 4% max return, again, as calculated by our BCI trade management calculator. The premium we receive after deducting the cost of the put You could see in the blue cell there is $285. And the possibility of trade upside if IBIT moves up to or beyond the 52 out of the money call strike is another 725. So there's an opportunity to generate over $1,000 in this particular 5-contract trade. Okay, we can go on and summarize in the next slide. Collar trades can offer significant protection to the downside, specifically against catastrophic losses. I've talked to you in the past, to the Quasar audience, Steve, about using in-the-money calls where we get protection to the downside for free in the form of intrinsic value of those in-the-money calls, but that's limited. I've talked to you about doing deep out-of-the-money cash-secured puts before entering a covered call trade. That will also give you significant protection, but limited. Having a protective put in place will protect you against extreme catastrophic losses. Now, the trade-off is that the premiums you're going to receive, the net premiums, will be lower than traditional covered call trades. And you saw that in this particular presentation. Now, again, one of the reasons that I like IBIT is that it has a robust but not crazy high implied volatility. And that makes it a good candidate for covered call writing, for cash secured puts, and certainly also for collars. And finally, you can use 2 of the BCI developed spreadsheets for calculating collars. First, our BCI collar calculator, as well as our BCI trade management calculator. Both of those spreadsheets are excellent for calculating collar trades. So, Steve, I hope your audience benefits from this presentation. In the current market conditions, I'm willing to say that it's going to entice many of your viewers, because a lot of people want to stay in the market. They want to generate premiums. They want to generate capital, but they also want to do it in a way that protects them on the downside. And this is a great way to do it.
And they want to be Bernie Madoff without the jumpsuit. So I like this. Very good, Alan. And we'll see you right back here next week, my man.
Looking forward to it. Thanks, Steve. Take care.